Hi guys, today is Wednesday, June 24th, and I just want to get on here really quickly and talk about FedEx's earnings report here, why they beat expectations but still are down. As in the after hours after their earnings announcement yesterday, they were down around 6%, and today again they're down around 1.5%. So it hasn't been a good 24 hours for FedEx really, despite their earnings beat. As with the numbers here, they had a quarter four revenue of 25.01 billion, and that was up from the 24.04 billion expected, which is and up 13% year over year. Their adjusted earnings per share was $6.31 per share, up from the 5.96 expected, and is up 4% year over year. Along with this, their 2026 revenue is 94.7 billion, up from 87.9 billion the previous year, and their full year adjusted earnings per share which is at $20.24, which is pretty good numbers for them. But they beat expectations for the most part, but they're still down. Their earnings beat was due to a 14% revenue jump in the FedEx Express segment, $21.5 billion to be exact, and is also driven by higher international export volumes and stronger U.S. domestic package yields. So they're making just more money generally from exporting internationally, and their profit was up in packages in the U.S. Along with this, they were able to cut about $1 billion in costs during the fiscal year, which is a pretty good number. It's going to allow for more cash on the balance sheet, and this was seen as they completed a tax-free spinoff of FedEx Freight. So now FedEx Freight is its own publicly traded company, along with the actual FedEx company. And along with this exit, FedEx Freight division transferred $4.1 billion to cash dividends back to FedEx. So they're boosting their cash on hand. They have $13.3 billion cash on hand, which is pretty good numbers for a balance sheet. So they have a lot of cash on hand, which is going to help them out here in the future. But they're down. And this is just because there is some disappointing forward guidance, as with the 2026 year outlook. They had revenue grew about 11%, and earnings per share between $16.9 and $18.1. The target stripped out the highly profitable freight division, though, that they successfully merged. So though they got more cash on hand, they're still not getting as much forward outlook as they want because of how good that freight division was for them. And these numbers for Wall Street, at least, were weak and conservative, and they weren't enough to create any reporting news for the company, or noise for the company, rather. And because of this, also, for core operations, the company, their profit margins went from 8.4% down to 7.7%, because they're doing a lot to pay their wages for their employees more. They're paying more in transportation costs and fuel spending because of the conflict in the Middle East that's going on. So the post-earnings decline is mostly mechanical, according to Bank of America, and it's mainly due to the freight spinoff that they had, where they took the freight company away because the freight company was so profitable for them and such a good part of their business, and now it's its own business. You're not going to see that reflect in FedEx's stock like it normally would have in years past. So it has nothing to do with the company FedEx itself performing bad. Unfortunately, it's just because they were really they're just losing a large chunk of what their business was. But there is some good news in here because they have so much cash on the balance sheet. They're going to use that to lean into shareholder rewards. They're going to target their $3.9 billion in capital expenditures. So they're gonna automation their fleet, and they're gonna make their fleet more optimized to hopefully bring that profitability back up. And they're going to try and have some share buyback opportunities to try and make their shares more valuable and worth more. So while they're down now, there are some things to look forward to in the future, but you do have to be a little bit wary because they lost that freight division. As always, be safe, and this is not financial advice.